representing Oakley Capital Investments. OCI, as I refer to it, is a much like the others, a listed investment company that gives access to high growth, high performing private companies throughout Europe. These are companies that are typically small to medium size in nature. And our differentiating factor here is that we're a direct listed PE investment company, i.e. we're the manager. We have a single manager in Oakley Capital. And Oakley Capital is one of the leading mid-market PE managers in Europe. We raised about 150 million at our IPO in 2007, and now that 150 million has a value of over 1.2 billion today. Our 10-year return is 283%. And that makes us one of the highest performing investment companies across all assets and sectors. I mean, you'll find actually one of the great things about listed PE, it's one of the highest performing sectors, full stop. And one of the reasons why, you know, it's a great kind of cohort to be amongst, and all four of those presenting today, I'd certainly endorse as companies worth owning. If we think about why private equity, and I'm going to whiz through this because obviously we've talked a bit about this in each of the different presentations, but I'll make my points as well. There is an incredibly large pool of private companies. If you look at companies in Europe over 100 million euros of revenue, 96% of those companies are private. And as we're constantly told, an increasing percentage of those are going to say private for longer or private full stop. And so if you don't, you know, on one hand, I'm going to make the case shortly for the outperformance of private equity. But if you're not giving yourself access to this asset class, you're not giving yourself access as an investor to a large pool of the GDP and the economic performance of companies throughout Europe, if not globally. If you just take the UK, of those companies backed by private equity, they represent 20% of the GDP. And typically these are companies which are new economy, if you like. They're fast growing, they're often tech driven companies as well. And in contrast, and you'll be very familiar with this, the public markets are shrinking in size. The number of companies listed since the 1960s has dropped by 75%. The AIM market is continuing, you know, to drop at a rapid rate in terms of the number of companies leaving that market, either to the full list or delisting. You know, we're failing the small mid-cap market. And in the meantime, public equities are consolidating around a small number of now very large companies. So let's talk quickly about performance. If we just compare, you know, what's the case for PE? You know, does it actually outperform public equities kind of consistently? So here's looking at 5-year compounded annual growth rates. So there's the FTSE All-Share. Maybe that's not the one to compare to. Maybe we'll compare to the MSCI or Global Index, which has, you know, kind of delivered a compound return of 13%. And I've taken 5 years. It's broadly the same whether we look at 3, 5 or 10. Then if you take the index of PE funds globally, they've outperformed the MSCI to 14%. Now, of course, many of us as retail investors can't access PE funds. You know, the minimum investment required for an Oakley fund is 5 to 10 million euros, and you're locked up in that fund for 10 years. So is OCI, our listed PE, is OCI a good proxy for that fund? And yes, if you look at the compound growth of OCI over the last 5 years, it's 16%. So there's the case for PE. It's a big section of the market that's untapped by public equities. It's often in sectors that you can't get access to through public equity, and it traditionally has outperformed public equities as well. Introducing Oakley Capital, that's the manager of the funds that OCI invests in, and it's one of the leading pan-European investors in the market. It's made 59 investments since its inception in 2007. Of those, it's realised its whole period is about 4 years. And for those that have reached their whole period, that's 26 of them that we've realised. We've realised those at an average 4.5 times our money, or a 68% IRR. It's one of the most impressive returns of any manager globally. One of the key areas that we'll continue to touch on that makes Oakley specialists origination. It's developed a reputation for being a founder-led investor who is looking to create a meaningful partnership with entrepreneurs, first-generation founders who are allowing PE into their business for the first time. 90% of the deals we do are with companies who have never had any kind of private equity investment up until that point in time. So I'm going to outline the kind of 5 kind of key ingredients, 5 key factors that are typically present in an Oakley deal to give you a sense of what drives the performance of Oakley investments. First up, we have focus in sectors and geographic focus. That focus geographically is throughout Europe, but if we look at the funds today, they're spread across kind of investments in UK, Germany, Southern Europe, kind of Italy, Spain, Portugal, and France. There's 4 key sectors. I'll go into them in slightly more detail shortly, but they are technology, digital consumer, business services, and education. Oakley is one of the most experienced and leading investors in education globally. I mentioned briefly origination, this point about being the kind of choice of entrepreneurs and a reputation that kind of leads us. How does that play out and why do founders kind of go with this? I think the kind of key point is that the founders, we're going to be very aligned with them. It's absolutely important that they retain an equity stake within the business. And so as a result, as they continue to own the company, they're often looking not for price maximization, but for a partner who's going to help them grow and develop and professionalize the business over the next 4 to 5 years to either allow them to make an outright sale, a sale to a strategic investor, or typically to a much larger global sponsor. So we're going to go on that operational, organizational maturity curve with them. And as you can imagine, as they allow a buyer in for the first time, it's a very personal and tentative step they make. Plus, let's be clear, founders are by their very nature, they are unorthodox, they are unconventional, they're rule breakers, they don't see the market in the same way that many of us do. And that is kind of core to their success. And you need the right kind of PE investment house that can empathize and bring the experience to the table which they appreciate. So 70, nearly 3/4 of the deals we've done are founder-led. And more importantly, the similar kind of percentage are uncontested, i.e. this is not part of some big auction process where it's all about getting the highest price. This is a bilateral discussion with us and the founder, establishing us as the right partner, not about establishing the highest price. And as a consequence, we often get into these companies 25% below the kind of peer group rating for these companies. And bear that in mind when you consider our valuations and our NAV. There's obviously a bunch of complexity there as a result of buying into kind of founder-led businesses. And we like that. Navigating that risk and complexity is often one of the ways in which we can create value. And proudly, we've backed about over 30 founders now, and they themselves have chosen, after investing with us, not only to bring us repeat deals, which they do, but also invest in the funds. And 300 million of the AUM is actually invested by those founders. Ticking through resilient business models, something you often hear PE talk about. This is finding disruptive models that are going to grow in spite of the broader market. Online solutions that will take share from traditional in-person service providers. And often, sometimes they're companies and models that you'll be familiar with. Say, for example, price comparison. However, there are plenty of, whilst that's a mature model here in the UK, there are plenty of jurisdictions in Europe, say for example Italy, where there's low penetration of those solutions. Take online insurance, car insurance. In the UK, 80 to 90% of car insurance is arranged online. We've invested in Facile in Italy 10 years ago, who have benefited from the fact that even today, only somewhere between 50 to 20% of car insurance is arranged online. Remarkably, only 50% of Italians have done any kind of e-commerce. And so there's kind of repeat geographic plays for us and regions where there's still low penetration of some of those models. There's some clear mega trends that we look to invest behind. They are the business shift to cloud solutions, the shift I've just mentioned, shift of consumers to online solutions, and the growing global demand for accessible, high quality education. And then finally, there's our ability to create value. We're control investors. We have a majority investment in the companies that we invest in, and it gives us the ability to affect outcomes in a concentrated portfolio of companies. And this is important. We make an investment case for each investment that we make that we can make 2.5 times our money, and we do so assuming that we're going to do so in a kind of a recessionary environment, a higher, not low interest rate environment where there might be modest deployment of debt, but M&A may be restricted. And with all those things, there must be ways in which we can create value regardless of that macroeconomic backdrop. And I'll go into some of the ways in which we do that shortly. So here are the 4 sectors, and dancing through them quickly. Technology, for us, that is infrastructure as a service. So web hosting is a very strong theme for us that we've been backing for some time, and software as a service. We're not going to buy the #1 SaaS player in a particular market, in a particular vertical. We're going to try and create that player through M&A. For example, we created the #1 business service software provider in Spain. There wasn't one. And through 12 acquisitions, we built a provider which is now the leading player in that particular market. When they're becoming established and big like that, they are expensive, there's a little value we can create, and they're more the domain of the global PEs. In education, we have backed and continue to back companies all the way from nursery education here in the UK, all the way through private schools, after-school tuition, online higher education, tertiary education, and industry training. Business services is another broad sector. It's areas where technology and best practice is disrupting an area where there hasn't traditionally been private equity investment. It's dental labs, it's car repair, it's optical solutions. And it gives us a real opportunity to consolidate in markets where that previously hasn't taken place. And finally, digital consumer. I've mentioned an example of this in Facile, but it's property portals, fitness apps, price comparison websites that are disrupting traditional consumer markets. I mentioned value creation, and these are the traditional ways in which we do that. M&A. If we look at our realized returns, a lot is 50% is thanks to organic EBITDA growth. The next biggest driver, 25% of returns, is through buy and build, doing M&A, picking up smaller M&A or a single transformational deal, but typically at much lower multiples than the ones we've acquired the original platform deal. Often we've got a local business and they're looking to branch outside of their local jurisdiction, either within Europe or globally. Although we're European focused, a number of our companies are now have increasing American, North and South American exposure as they look to expand their offering. AI is a hot theme, and so is digitization, and a number of our businesses now are transforming their customer proposition by embracing AI, and I'll talk about one example shortly. Sustainability, a very broad and politicized term, but ultimately it's going to be very much like digital. Does your company, has it assessed the risks of the region, the climate it's going to operate in, and to understand its cyber risks? Is it going to be able to grow in a responsible and sustainable way? And we have a team of 5 people here at Oakley helping companies do just that. And then talent. Founder-led businesses are traditionally companies where there's a single founder, where all the knowledge and control coalesces around one individual. As they look to mature their businesses, they have to allow a broader senior management around them in order to help the company grow more efficiently. So here's an example, IU Group. It's the largest and fastest growing university in Germany, and its key proposition is that it provides accessible online degrees to students, not just now in Germany, but throughout Europe and globally. They offer as a result of being modular high quality degrees. There's some 300 different types of degrees that individuals can put together. These are typically individuals that are on average age 27, maybe don't have a higher education background in terms of a family that had higher education. They're in work, they may have families, and this is enabling them to afford a degree that is going to help them retrain and move into a particular different working field. Over 60% of the degrees are completed, which is unheard of in online education. And salaries on average increased 20% as a result of taking on these deals, as a result of doing these degrees. It's a founder-led business venture. We carved it out of Apollo Education, a complex deal. As you can imagine, it has highly visible recurring revenues. It's an online solution, and more importantly, they've adopted a AI teaching assistant, Cynthia. It's incredibly effective at being able, versus the typical tutor, at being available whenever the student wants it to be, and to have a much more kind of proactive and effective way at helping teaching the student, who asks 10 times more questions of an AI assistant than they would of a human. Let's look at the value creation. So we invested in this business in 2017 with a value of 170 million, had 15,000 students. Fast forward, an expansion of the C-suite. We encouraged the firm to spend much more on marketing, develop Cynthia tools, and we've now enabled them to, through M&A, to award degrees outside of Germany and London and Canada. It has 140,000 students today, over that number, and has exceeded a 2 billion valuation in that initial 6 years of ownership. And recent deals reflect similar kind of themes. Founder-led businesses that are disrupting certain fields. Vitro Connect is taking advantage of the growth finally in fiber within Germany, eye tracing, cybersecurity defense, and Assured Data is helping companies recover from cyber attacks with cloud disaster recovery solutions. So clicking through quickly on OCI, here's that 1.2 billion of net asset value, which the majority of which is in fund investments. I'll allow you to look at this in more detail post this presentation, but you can see we're spread across these 33 companies. You get a slice of each of these companies, and you can see very clearly, right, we're trying to be as transparent as possible about what we own and how much you own of each company. To give that in kind of more broader terms, you can see that you're broadly spread across those 4 focus sectors that I mentioned earlier, and across those geographies with the UK, Germany, and Spain kind of leading that group. Importantly, Oakley's opportunity-led. If one of those sectors suddenly is mispriced, too high, or one of the geographies there isn't opportunity, we simply won't invest in that particular area. We didn't invest in the UK for a number of years because we didn't find value and growth or founders that we wanted to back. In more recent years, in a slightly more disrupted buyer's market, we've been able to find more opportunities. Here's the average KPIs of that portfolio. Despite the kind of market backdrop, the companies that are growing an organic average 14%. They're relatively lowly levered at 3.9 times. That compares to a broader PE market that's more like 5 to 6 times, and it's a number that's declined more recently. And the average valuation weighted for those companies is 16.4 times. To compare that to the average rating of a NASDAQ or S&P, and it compares very favorably. I would say at this point that growth rate is relatively modest for us. More typical growth rate for us would be 25–30%, and it slightly reflects the current economic backdrop that we're trading in. Can you trust the NAV? Well, there are a number of ways to kind of hopefully outline the fact of the credibility of the asset value. One, OCI and the board independently, it's revalued every quarter, but once a year that has just taken place. The OCI board independently value the companies and have them audited. Traditionally, throughout our history, exits have been performed at an average uplift to the book of 26%, and even in a relatively difficult M&A environment, the one we've just experienced over the last year or so, we've been selling assets at least at NAV. There is also now, in a broader secondary market is the market in which people trade positions within the funds, and the Oakley funds positions have been trading at anywhere between NAV and 10%, even in this market in kind of recent months. And then finally, and it's been touched on previous slides, the manager is not incentivized by unrealized gains. So the current value of the portfolio, there is no performance fees being paid to the manager. The management fee is on what's committed to the funds, not on the holding value of the funds. They only get paid a performance fee if it exceeds an 8% hurdle and it's a realized return. And finally, in the last couple of slides, as I draw to a close, first of all, we've touched on the discount, and maybe I can offer some thoughts around how that discount could potentially close. Excuse me. Firstly, I make the point that because the discount exists, we focus a lot upon discount, or the media does, and investors understandably do, and analysts do. I would say that the thing to focus on is NAV growth. That's what drives shareholder return more typically. And if you look at some of the highest performing listed PE firms, that performance has been driven by NAV growth. If I look back at kind of recent years, the top 3 performers have included a listed PE firm that's trading at par, at NAV, one that was trading at 15% discount, one that was trading at a 35% discount. The thing that drove their leading return, and one of those was OCI, was NAV growth, not the discount. Now, the discount closing provides us with upside, and it provides us with safety if we buy the shares now. And in many of the shares, including ours, a discount has been prevalent for a little while. I have every belief it will close, but don't make the investment singly on that basis. So why do they exist? I've identified 3 of the reasons here, some of which we have some control over, some of which we don't, but they're structural reasons. Whether that's because there's been significant fund outflows, 22 billion outflows out of the UK for the last 3 years, repeatedly, and the small and mid-cap market, it doesn't matter if it's investment companies or small mid-cap, there has been consistent sell-off of that sector, driven in line with kind of a higher interest rate environment and also low economic confidence, which has meant a kind of flight to quality. Now, you can judge whether or not that particular trend is going to reverse, but there's obviously a lot of commentators that think it is going to. And then there's the cost disclosure regime, which kind of penalizes investment companies by making wealth managers and IFAs report a cost to their underlying investors, which makes it appear that it's an additional cost that you have to pay for owning investment companies, which you don't. It's a cost which has already come out of the NAV. It's a cost like any company has, or an operational company has. You don't tell someone that it's cost you £1,000 to own Vodafone. It's accepted that it's in their report and accounts what their operational costs are. So what can we do, or how can we take advantage of this at the moment? Well, let's focus on our capital allocation, prove that we have strong kind of corporate governance, take advantage of that discount through buybacks when we have the kind of cash or liquidity that allows us to. We're working closely with those cost disclosure campaign team, and we're helping retail, who I think are going to, many more investors take control of their own investments rather than funds, to kind of understand PE and understand the listed PE opportunity. there's a lot of negative perceptions around PE generally, and listed PE, and it's generally poorly understood. You know, are PE returns based on cheap debt? Is low IPO activity, you know, brought the PE kind of, you know, model to a shuddering halt? Is there kind of investment constipation? Are we Ponzi scheme? The kind of list goes on, and are often perpetuated by the media. Ultimately, if we, OCI and the sector, can continue to perform through what has been a recessionary or a difficult macro and geopolitical environment, we're going to ultimately convince the market, I believe, that this is a high quality sector producing resilient returns over the long term in both positive trading environments, as we have done prior to and up to COVID and beyond. And then finally, there's this kind of oxymoron, isn't there, with private, you know, just that, you know, we're public companies, but we're private assets, and we're looking to kind of preserve some of the advantages of being private, and there's an information advantage of being private. There's also the difficulty to understanding the underlying investments, and there's this completely justifiable sense that when I'm buying into a black box, an opaque asset value that I'm learning to trust, and research doesn't really often help reveal much about the underlying companies. And so I think, how do you kind of deal with that low confidence in valuations or low confidence in future growth? Well, it's about events like this. It's increased transparency. It's in having reported accounts that can give as much detail as possible on the companies, how they grow, giving access to the CEOs, having really extensive and deep and detailed capital market days, and improving generally the communications sector. I think we've come on leaps and bounds. OCI, you know, much like some of the others presenting on SAMI, are award-winning for that disclosure. And I think we have to keep innovating and pushing that. Just finally on the outlook, what can we expect for this year? You know, some of those structural trends are going to continue to play in our favour. And so expect to see that gathering momentum in terms of earnings growth. Realising returns is even going to help prove to people that NAV is the NAV. And if we can do that above NAV, even better. It's a great market for making investments. We've never been in a better environment. We're setting the foundations for the future. And with all those things being equal, the discount should over time close.
Stephen, thank you. Thank you so much. Really interesting discussion. And I'm fascinated by what you were saying at the back end there about the 10-year performance, very strong performance, and your outlook for the discount. I want to pick up though, if I can, very quickly on the AI side of things. We're all engaging with AI more and more and more. It's a very fast moving sector. How do you pin down investments? Are you concerned at all that maybe we're still in too early? We've heard a lot recently about the developments in China with DeepSeek. Just seems to have wiped off enormous amounts of money out of the States. It's a sector that I don't think anybody can really at this point pin down properly. How do you go about investing in this sector?
Well, I guess it's true. We do have access to companies that are backed by generative AI. That's a relatively small percentage of the portfolio. In terms of the existing portfolio, we're looking for AI. They're not AI businesses, but they're businesses that we feel that can benefit from the introduction of AI, like an AI teaching assistant or an AI assistant that helps one of our legal data platforms to interrogate the underlying data. So AI is helping us improve and disrupt the markets we're already in. We're not taking a bet on AI infrastructure, large language models, that, you know, the winner of that particular race. We're going to benefit from that because, you know, as these models get better, as they get more accessible, as they get cheaper, then there are companies which can benefit from that. We're looking to kind of disrupt existing verticals, sectors where that technology can enhance the proposition.
Yeah. I heard a lot about 2025 expectations from our guests so far. How do you view this? And one of the questions is, are there any portfolio companies you're expecting to exit this year, hopefully giving rise to profits for investors?
Yeah, we are cautiously optimistic in 25. I don't think we kind of get carried away. There's obviously, you know, signs of increasing kind of M&A activity, which is positive from an exits perspective. And we've had some, you know, quite attractive kind of early approaches for the companies. As to whether they get sold as a result of that, you know, only kind of time will tell. Our average holders, I think I mentioned for a portfolio company, is 4 years. the average hold of the portfolio company today is about 3.3 years. So you might imagine that there's going to be a number of companies over the course of the next 12 months that will be in a position where we could realise our kind of target returns. Look, even in difficult markets, we've always been able to realise investments, and I'm sure 25 will be no different.